And welcome back to Biz Mafia, where business gets made. I'm your co-host, Brian Taylor, joined by my partner, Pat Linden. Pat, how are you?
Good, buddy. We're both suffering a little bit from the COVID, but whatever flu's going around, it's awful this year.
Loss of voice and everything. I think this is our Jordan flu game,
This
right?
is our Jordan flu game. Great analogy. In fact, we had to push this interview because I got sick and then Brian got sick. But excited to get it back on the books today and get on track.
That's right. I think the wait is worth it. Individual we have coming up by the name of Kirk Michie is an extraordinary individual, someone whose approach is genuinely noteworthy. So I'm very excited to get into the particulars there. He possesses a unique quality of authenticity in his actions, consistently demonstrating the courage to challenge the status quo when it's most appropriate. So excited to get into that.
Yeah, my sense, having had a little prelim conversation with Kirk and kind of seeing his background, is he's a contrarian thinker in a good way. He is all about advocating for the client when it comes to investment banking services, raising capital, and primarily sell-side M&A. And he's got a non-traditional approach, but I think an impactful and the right one. And hopefully he's going to get into that today. He's also done an amazing job of building his business into becoming very formidable, small professional services doing big time work. So I know we're excited, Brian, to hear about the marketing and BD front.
Yeah, let's start with that, Pat, to give the audience a little more background. Kurt is the mastermind behind Candor Advisors, which Pat just mentioned. It's a firm founded on its extensive 30 years of experience guiding founders and families through strategic challenges to achieve their capital raising and business sale objectives. Over the last 30 years, Kirk has been pivotal in managing and sourcing over $1 billion of M&A transactions and over 60 deals. Separately, he's helped raise more than $1 billion for founders and entrepreneurs.
And a very kind of energetic, intelligent, thoughtful guy based out of LA. So I don't know, buddy, what do you say? We bring him on?
Let's do it. I'm excited to hear from him. So without further ado, let's welcome Kirk to the show. Kirk, welcome to the show.
Thanks, Brian. Good to be here.
To start, could you tell us a little bit more about Candor Advisors and really how you built the organization?
Sure. I mean, I think the easiest way to think about it is that we're a boutique investment bank and transaction advisory firm. We started out with the idea that we would just help selling founders hire the right investment bankers, the right lawyers, kind of build the deal team and guide them as far along that process as they needed to be. What happened along the way is several of them asked us to be the investment bank. We were already licensed that way anyway. So we kind of got pulled into it. And I won't say that we regret any part of that, but it is nice to kind of get invited to be the investment banker rather than decide you are the investment banker.
So, Kirk, you mentioned something offline, and I thought it was really fascinating and well put, is that your role, that you are part guru, part guide, and part gladiator. Great on that?
Yeah, absolutely. I have to give credit to an advisory board member who came up with this years ago, and he did not protect the intellectual property, a friend of mine named Kevin Hofberg. And what he talked to me about is the idea that, like, when you're kind of in sync with the client, you have this kind of covenant where you are not necessarily equal parts, but at different times in a transaction or an advisory engagement, guru, that's what they think they're paying you for, because you know stuff that they don't know. You're a subject matter expert, whether it be in M&A or some other area. And then there's guide. I mean, look, all of us have a certain amount of experience that we can, and maybe even scar tissue that we can lend to our clients to say, look, when I've been through this before, here's a best practice. Here's what I've seen go wrong. We're at an inflection point. And so here's my guidance to you, right? And then the most important piece and the most difficult to practice as an advisor, because this is a risk, is gladiator. And I don't mean that fighting with the other investment banker or the buyer or the lawyer on the other side on behalf of my client. I mean, I'm battling current you, my client, on behalf of future you, the client you've expressed a desire to be. Because chances are, if we're in a charged kind of transactional environment, you're going to be your own worst enemy at times. You're going to not know which things are invasive and accusatory and which things are just the way M&A works. And so it's really incumbent on the advisor to be confident enough that he or she knows when to be guru, when to be guide, when to be gladiator.
That's a great way of putting it. I've talked to Pat about this quite a bit offline too. It's almost like with the years of experience that you build up, you become Nostradamus. It's just from seeing it firsthand, right? And so it's easier for you to kind of pass that along to your clients or even prospective clients and provide that advice. Pat, I'm curious, would you add anything to those comments?
I thought that was a great way of putting it. I really like it. I'm going to take that and use it. So I'm glad that it's not trademarked. But I think, Kirk, one of the things that we identified with, and I'm curious to get your perspective on, is on the guru part, there's sort of a table stakes. You have to have the experience and the acumen to have done a lot of transactions. I know that's the case on the investment banking side. It's the case on the legal side. I tend to find with our typical client that may have a great business. Maybe they've generated a $5, $6, $7 million EBITDA business, $2 million EBITDA business. Doesn't matter. It's they really know their industry, but they probably haven't been through a bet the company, bet your legacy type transaction, especially if you're talking about the buyer being private equity or a public company. And so the buyer typically has the advantage in those situations, making the advisory piece critically important on the sell side. And so one of the things that you and I think, identified and shared in philosophy is the advocacies, because the base legal understanding, the base investment banking understanding is table stakes. There's this psychological element of coaching and also knowing when a lot of really smart deal makers are overstepping their bounds, or maybe they're not as in sync, or they're trusting their attorneys too much, or they're trusting their bankers and they're the smartest people in the room. Is that your perspective? And then how do you manage that process being sort of this boutique investment banker?
Everything you said is spot on. So it's all correct. And what's tricky for a selling founder when they're meeting you, me, any other transactional professional is that they will oftentimes think that we're really, really smart. And maybe we are, but the thing is, transactional professionals have a language all of their own. And they also have all that built up scar tissue around knowing, kind of which things are common and which things are uncommon. And so a great advisor has to minimally know what kind of market and non-market terms are, has to be in the market often enough that they know what's going on in terms of sentiment and valuation. Also has to have a pretty good sense how to talk to a client about what's going on in their particular sector before they ever start thinking about putting together materials or a buyer universe or a deck or a book. Like you said, it's table stakes to know that stuff. And frankly, the trickiest thing here is that, maybe our client has 30-year-old injection molding company, and there's nothing about that area of expertise that he or she doesn't know, but they've never been through a sale process. On the other side of the equation, the associate at the private equity firm that made a cold email or call to that founder has worked on more deals in the first quarter of 2024 than that selling founder will be involved in his entire life. And so what ends up happening, at least within our firm, is we think about the buyer of the business being a full-time predator and the seller of the business being part-time prey. And it's why they need advisors like us. It's not that the buyers are bad people. It's not that they have ill motives. It's just that, some of buyer behavior, in fact, a lot of buyer behavior, when looked at sort of objectively, looks predatory. Because whether they're a strategic buyer or a financial buyer, once they've decided they like your client's company, they want to buy it for as little money as they can come across with. And they want to add structure that gives them an advantage, right? So our clients need us just to neutralize things there, to be shields in that kind of, potential battle.
So Kirk, that's so interesting and true. And one of the things that I don't think your everyday business owner who's not been through the process understands is the complexity. They may have been used to, for example, running budgets for their business. They may have been used to supply contracts and those types of things. And then we all have some experience, for the most part, in buying and selling a real estate property or two, or whatever the case is. Could you explain just how different, I think, for the benefit of our audience, a lot of whom are kind of entrepreneurs that are stable, getting to the next level. They think an exit could be on the horizon, and educate them on just why it's such an intense process.
From a buyer's perspective, this isn't like selling a piece of residential or commercial real estate or an exotic car or some other high value asset that is quite literally an asset. And there's a market value to it. And I know that in commercial real estate, you also probably have an income stream attached to it. But the reality is that selling a company, you're selling transferable economics. Now, we tend to refer to those as annual or net recurring revenue or EBITDA or adjusted EBITDA. But what you're really selling is those transferable economics, the intellectual property that supports them, whether those be special industry expertise or formulations or differentiated strategies, kind of unique ways of doing things, maybe even actual protected intellectual property, like, kind of in life science businesses or in technology businesses, things that other people don't know how to do. So you're selling all those things, and all those things are intangible assets. And so when a buyer comes in and wants to take control of that stream of transferable economics, then they'd like to pay as little as possible for them. And the reality is there is a market. There are databases. There is plenty of live current information about what's happening in the marketplace to say, okay, this is a heads up transaction and that buyer is coming across with a reasonable range of value, or this jerk's trying to pick your pocket and you need to, move them along, right? And so they need people like us just minimally to just make sure that they're not going to get taken advantage of.
How often does it still become emotional, though, for the seller?
Yeah. So, within Candor Advisors, one of the things we talk about is the idea that it's all behavior, right? Because what ends up happening is most of the people that we represent have been building their business for probably the shortest we've represented was 5.5 years. And the longest we've represented is multiple generations, right? Those are, you have a lot of your identity and personality tied up in those things. So the buyer, no matter how they describe themselves as being founder friendly or supportive or growth oriented, or we love to work with, sellers to unlock the true value of their business, no matter what language they use. The reality is that once we're in due diligence, once we've got a co-signed letter of intent and we're in a period of exclusivity where nobody else can bid, then the buyer's going to come across with a bunch of questions that, to use a term I think I used earlier, seem invasive and accusatory. And from a seller's perspective, the natural thing to do when somebody appears to be insulting or accusing or, questioning you is to react, right? Most great entrepreneurs they're successful because they've got great instincts. And the natural thing to do is react. And so one of the behavioral elements and one of the kind of the gladiator pieces here is, as advisors, we need to tell them which things to react to and which things to not react to, or which times to say, hey, look, on this one, I'm going to be the designated asshole. I'm going to react so that you don't have to, because you might have to be working in partnership with these people after they buy your company. And so I know they offended you with this request or them questioning your financials or some other thing. Let me take this. And then we're not being disingenuous, but we might need to be kind of strategically offended on behalf of our client and push back on it.
Yeah, absolutely, it does. I'm thinking about something else too. And it's hard for some advisors to walk away from deals, but you've also mentioned that you've had the ability to say no. Can you expand on that? Because I think that is impactful, right? On behalf of your partners, right? Your client is to be able to tell them when enough's enough, you should walk away, and what goes into those type of decisions.
Part of this is that, kind of our North Star is we guide founders to better outcomes. And better outcomes, that doesn't always mean a sale to an external buyer. There are businesses where they're not going to get maximum value by selling to an external buyer. There are businesses that will only get maximal value or optimal value by selling to a strategic buyer. And then there are those that would be ideal in selling to a private equity buyer. So thing one is, what's the seller's why in selling? Because it's really, really important that we match up the type of buyer with the why to make sure that there's alignment there. And kind of part and parcel to that is the idea that if it's the wrong buyer or the wrong terms, or we spot things in the buyer behavior that are particularly predatory, then we have to have the courage of our convictions to sit down with our client and say, you know what, this is not the right legacy for the business that you built. We believe, based on the buyer universe that we have, or based on our market intelligence, or based on the sentiment out there, that there are better buyers or there are better multiples. And we can take you to market, or we can take you back to market to try and achieve some of those, or we can kind of take down the sale process for a while, wait this one out, or we can push back really, really hard on this buyer and see what happens. But we absolutely have to be willing to say, look, this may or may not be the right time. These may or may not be the right terms. This may or may not be the right valuation, but we have to have alignment on all of those things to make sure that whomever's built up a business over decades or generations gets the right number, because they only get one chance to sell it. No matter how many existential crises they've been through in the time they're building it, they only get one time.
That leads to something I think is really important. I think we like to give strategic advice to people on this show, and you've given a great opportunity to do that, which is preparedness, first of all. And I like to kind of compare it to staging for a house, although that's about the only thing that's it's like 10 times harder to sell your business. But starting early, I want to get to that in a minute, but I don't want to lose sight of that. And sort of, you have a little bit of a non-traditional approach, which is for the long term, and sometimes going, hey, look, you need to be doing these things 2-3 years out to get quality of earnings ready. All these things that owners don't want to do because A, they're so busy with what's in front of them. B, it costs money and you don't see the immediate return, but you will see the return likely in the form of a multiple on every dollar that gets paid. So there's a real kind of ROI from that. And I want you to speak to that. Separately from that, you have to treat the transaction in preparing from the beginning, if you can, be competitive about it, right? And you talked about this, talk us through this, which is no buyer ever goes in to pay more money than they have to. And they're very coordinated. And they've been through it, and they're running the numbers, and they're trying to figure out what they can do on the back end with their growth models and so on. So that to what you and I talked about, which is the importance of the letter of intent, which everybody completely underestimates, by the way. And my personal opinion is have some of the tough conversations and really get the blueprint for the deal up front, because there are known market terms, limits, and this, that, and the other. And those things can change when the buyer looks under the hood and if there's a reasonable but you certainly are not getting those things if you don't go in and kind of bang them out in the letter of intent. And it's not going to get easier through the process. Can you take us through your opinion on that in terms of competition readiness, i.e. auctions and so forth, and your personal approach on the letter of intent?
Yeah, absolutely. So you nailed a lot of really critical topics there, Pat. And let's kind of unpack them sort of in order. So the first one is, in terms of the preparedness, a lot of sellers mistakenly think that the outreach from a non-decision maker at a private equity firm, or, even the corporate development person at a public company who's trying to get deals done, who's also not a decision maker, has reached out. They're building rapport with you, the seller, by essentially saying, hey, we're looking for businesses like yours, or specifically, we've been tracking your company and we find it, particularly attractive to us for the following reasons. And if you're open to selling, you just provide us with a few bits of information, we can give you a sense of, what we would pay for your company, right? So massive red flags jump out there. And if you're the seller, you have no idea, because that sounds like a heads up, friendly conversation.
Absolutely.
Right? So there's no non-disclosure agreement in place. So here's this, potential large competitor, if it's a strategic buyer, or a private equity firm that's looking at you and other companies like you at the same time. And if there's no confidentiality agreement or non-disclosure agreement in place, first of all, don't provide them with anything, because even though it's an industry best practice in M&A to keep silent on anything you're working on, look, the reality is it could kill your company to share information with a competitor or a private equity firm that buys one of your competitors, because you can't really prove that they learned whatever they learned by seeing it in your financials. So, one of the critical things in preparing from a long ways out, and a long ways could be 6 months, it could be 36 months, is look, understand what buyers are paying up for in your sector or overall. Understand the things that will hurt. For instance, if annual recurring revenue is the thing that buyers pay a multiple of for you, well, then don't worry so much about EBITDA. Just make sure that you've got as much annual recurring revenue as possible, right? Focus on that in your next 18 months worth of activity. Or if adjusted EBITDA is what buyers pay a multiple of in your sector, well, then work on that and make sure you're maximizing, the adjusted EBITDA. If buyers will discount the value of your company based on customer concentrations or supplier concentrations because they feel that your company is riskier if 50% of your business comes from one customer, well, then work to diversify your customer base further. But, know the target that you're aiming at so that you don't hope by the time you get to that LOI, Pat, that they're going to give you a fabulous offer. And even if you haven't got everything figured out in the LOI, it'll be this nice collaborative hand-holding sing-songy process down the road and you'll get to the right outcome. Because the reality is, and this, I take this from another friend of mine who's an M&A lawyer. He says, nothing ever gets better after the LOI. Once you've executed the LOI, you got to kind of think about the fact that you've probably, as the seller, you've probably lost most, if not all of your leverage. That document may not be binding in its entirety, but it forms the basis for what the purchase agreement is going to look like. And it certainly forms the basis for what the valuation looks like, what the structure of the deal looks like, maybe how financing is going to be done, might touch on the net working capital, might even talk about what's expected of the seller and the employees, right? So first preparing for, what's going to maximize value and which things are going to hurt you. And then by the time you get to that LOI, make sure that you've got that NDA in place and make sure also that you don't sign it until you get to a deal that you really want to do.
There's a couple other things I think it's a good opportunity to layer in here, which is it's true that the LOI is non-binding except for some basic. I think parties have the wrong perception if they haven't been through the process. Well, it's not binding. It doesn't know. It actually is sort of a major moral commitment. Let me elaborate on that further. Don't assume if you're ever selling a company. I mean, I make a living in this. I can speak from authority. Don't assume, first off, just because you have an LOI, that's how the purchase agreement's going to get in. Because I could point you to like every big law firm, not all of them. I shouldn't throw them all under the bus, but a lot of them. When you get the purchase agreement, it's radically different because they pay very little attention to that, and they're not very good at really tailoring things to a specified letter of intent. They want to do absolutely everything for their client. They want to take no risk, so on and so forth, right? So the importance of the letter of intent in that situation and many others is to come back and go, no. We agreed on this as gentlemen, ladies and gentlemen, we agreed on this. And there's nothing in the due diligence that either has come up or will come up that would reasonably justify deviating from that. And if you're a reasonable business person or a high-level private equity person or whatever the case is, you're going to have a very hard time arguing against that position of logic, right? So is that a fair assessment?
Absolutely. It's good call out on the fact that the APA or stock purchase agreement could end up diverging pretty heavily from the LOI. And it's also incumbent on the advisor to basically say, hey, look, you can try and blame that on your big law firm as, that's how they interpreted the LOI. Retrade isn't just a change of valuation, it's a change of terms. And no buyer, whether they're strategic or financial, ever wants to get accused of or labeled as retrading. But it is so common that, I wish there were a database that were only controllable by seller advisors who could just mark people as retraders, because within the M&A community, it's pretty well known. And, the thing that's happening now is that there's so much dry powder out there for private equity to invest. And now, whether it's independent sponsors, like experienced private equity people who just don't want to raise a fund because they don't want to have the governance hassle or the cost of doing fund reporting and investor relations. So they just want to do a deal at a time, or search funds that have, executives who've never bought a company have gone out and convinced a few investors to back them in buying an individual company. There's so much competition for deals out there, contrary to the way a lot of the buyout community is talking about how multiples have come down and all that other stuff. There's so much competition for good deals out there that there are groups that are lobbing in letters of intent with no real plan to actually go forward under those terms. They start due diligence with the idea they're looking for something to allow them to retrade a deal. and figure that maybe inertia helps them get it across the line. Maybe the seller gets so deal fatigued or so far down the line with the deal that it doesn't matter that they started at a $35 million valuation and now they're at 26.5, and they started with, 80% cash at closing and now they're at 45% cash at closing with a whole bunch of structure. There are groups who readily and frequently do this. They lock up a deal with an LOI to try and eliminate the competition and drag out due diligence and then try and get the deal cheaper. So,
I think I want to use that to talk a little bit about Candor Advisors too. That is, you have the table stakes, which we talked about. You have the guru. Okay. Part of the gladiator, although maybe in a little bit different of a way than you said, is your role, and I know you do this, is to get to the bottom of it, to figure who's real, who's not, who can get to the end, and how you can do it in a manner so that you not only get what you think you're going to get, but you retain that through the transaction process, whereas, very easy to get eradicated, especially with high-level PEs, public companies, and their attorneys.
Absolutely. And I can point to corporate development people at public companies. I can point to originating partners at private equity firms, and I can point to partners at law firms who would all tell you, they've all sat across the table from us, and they would all give us their respect. And they would say, I don't know that I would want to take long showers with Kirk he dealt fairly, and he was heads up, and it wasn't fun at different points, but I respect the guy's deal acumen, right? I don't want the other side feeling like, oh, he's wonderful, I'll do deals with him all day long. And that is not my goal. I believe, whether it's legally true or not, that I have a fiduciary responsibility to my client to get them to the best outcome. And sometimes the best outcome is to chase away a bad buyer. And I don't care how far down the road we are. One of the things that all sellers ought to be aware of, especially if their buyer is a big private equity fund or public company, is their buyer has invested a whole lot more in external fees and internal, human capital, that their sunk cost, the buyer's sunk cost, is far higher than the seller's sunk cost at any point in the deal. So if it's the right thing to do to say, hey, look, no, we're not going to extend exclusivity because you guys appear to be dragging it out. So you can either close the transaction, in the next month, or, we're going to tear up exclusivity, or we're going to let exclusivity fade and we're going to go back to some of the other buyers, or like whatever the conversation has to be. I'm a likable guy. And so even when I have to come across to a buyer with a difficult conversation, I know at the end of the day that I'm coming from the right place, which is, I'm not trying to screw anybody over. I just want to make sure that my client gets the best possible outcome, not at the expense of the buyer, but just holding the buyer to the terms that we struck in the first place.
Incredibly important. The way that I always put it, I know I've told Brian this, I always feel like in my representations, because I'm on the company/entrepreneur side, it's not to run it back for a touchdown. It's really to get to the 50. And typically the position that we're put on, unless we come at it with a guy like yourself and me, and we're really, that's the optimal. It doesn't always happen that way. Sometimes I get pulled in and I've got to work with the lousy letter of intent or whatever, and don't have the ammunition. It's suboptimal, but there's a group think dynamic. We talked about this a little bit. I really want to get your opinion on this. When you're dealing with private equity, for example, they will have done more deals than you as a seller. They've probably done hundreds. That's what they've been doing their entire life. So of course they're going to know more, just like you're going to know more about having run your business and your industry. But people at that level, I find it's really fascinating. I call it the group think dynamic in deals. And you're going to have some private equity guy with his Harvard MBA, Stanford MBA, or Columbia MBA, whatever the case is, probably going to have some national law firm with a bunch of Ivy League pedigree, or even guys like me. I was, in fairness, I did that for 15 years or whatever. And they're all going to think that they're hiring the best of the best. My attorneys are the best of the best. These PEs are the best of the best. And then what ends up happening is you have advisors, sometimes who aren't even that senior, who get involved in the trenches, and they just lose all practical perspective. And this deal that you had it runs amok. Everything that you thought were these basic kind of terms or whatever, when you get into the weeds of hundreds of pages, it's just crazy. And you can't make heads or tails of it. And then part of the groupthink problem is it becomes very difficult because these people all think they're very smart, and they all think their advisors are very smart, and they are, but they have a very hard time thinking outside the box.
Yep.
and doing things outside of their checklist, especially if it's PE and they go, well, we have to go through these 300 things for our limited partners where it has a negative implication on your client, won't have a negative implication on them. But to get over these basic things is incredibly difficult sometimes.
Yeah.
And you've got to be willing to call them on it. Sometimes you've got to be willing to get the top principal on and go, hey man, like I know you've got your Ivy League lawyers and all this on this, but this is just a basic sentence. I mean, how can you not agree to? And sometimes that works.
Yeah.
The challenge with that, actually, I would say most of the time it works. The challenge is they're uncomfortable. So tell us, as an advisor, that's part of the job. What is your approach on those situations?
Yeah.
How do you work through that group thing?
So this is a fantastic question, Pat. And I don't think, first of all, none of the other podcasts I've ever been on have asked that question or even delved into that area. It is the thing that makes deals more expensive. What we often tell sellers is that buyer's counsel is probably going to make your legal fees higher. And there's a part of that that's reasonable. And then there's a part of that we're going to want to push back. And so you're kind of nailing it. What happens is the non-principals get involved in direct communication, whether it's, Ernst & Young doing due diligence on the financial side of the buyer, and then, my client's CPA talking to them, and my client's CPA doesn't cost nearly as much as Ernst & Young. And then, the next thing you know, Skadden Arps is their deal counsel, and I've got Pat Linden on my side, and I know Pat's fees are going to be reasonable, and Skadden's going to, have $1,800 an hour lawyers with, 9 slots on the Zoom screen in every call. And
they're going, this guy at Candor Advisors and this guy Linden are maybe not you, but they're going, this guy's just an idiot, by the way.
I have had a public company CEO say, hey, advisor guy, what was your name? And I said, and I quote, it's Kirk, but if advisor guy is easier for you to remember, go ahead. Like, I don't really care what the buyer thinks of me, right? I'm just I'm trying to get the right outcome. But, Pat, to your point, sometimes the right answer there is to have our client, the seller, go to the CEO of the buyer and just suggest that our client send a text or an email to the CEO of the buyer and say, listen, our lawyers are arguing over form and not substance, and it's going to cost you $500,000 more and me $200,000. Can we agree, since we got to terms on the LOI, that some of the stuff they're arguing about is probably not that important? What happens is the next call with lawyers, accountants, outside advisors is chilly. The next call is pretty chilly because somebody has opened a can of whoop ass on their advisor and said, enough already, get this deal done. Right? But after that chilly next call, things tend to move along. And you're absolutely right. Sometimes it just takes principal talking to principal to say, hey, look, we're business guys here. Let's get this thing done. And then the other piece is that, that groupthink that you're talking about, there's a certain inertia to that where, people think, well, this is just how things are going to go. It's different with different kind of buyers, right? Private equity firms tend to be better buyers of companies. They know how to do due diligence. They know exactly who to use on which part. They will typically lead with financial diligence. They will make sure that the transferable economics are validatable so that they can move forward with everything else. And once they get through legal diligence without any big blowups, then they'll move through, business, regulatory, HR, a lot of the other stuff as more or less confirmatory diligence. Now, private equity firms will keep asking questions right up until a half hour before you close.
Oh, yeah.
Because, look, they're in the risk mitigation business. They're not operators, right? So they're not sure if they've asked all the most relevant questions. On the other hand, strategic buyers, especially public companies, are better at understanding the stuff they're getting in due diligence, but they're not as good at sort of prosecuting due diligence, if you will. They might have a 140 question questionnaire with sub questionnaires for legal and accounting and tax and HR. They're not very good at cutting down their standard questionnaire for this particular business that we're selling them. So a lot of times you don't really know where you are with a big corporate buyer in terms, because they're not marking anything done on the due diligence tracker. So some of that, kind of groupthink and things kind of moving along, some of the most important thing that a Pat or a Kirk can do in that process is to hold everybody to more of a diligence timeline and say, where are we? Which things can we cross off? which things can we agree that we're substantially done with? So from my perspective, part of our role is to just make sure that somebody is quarterbacking, somebody is making sure that everybody's doing what they need to do.
It also ties back to your comments earlier about the importance of the LOI, right? It's to hold something accountable for both parties that's already been agreed to. I think that's a great point.
The other thing, Kirk, and then I know there's a lot of other great content we want to get to, but I think what you're saying, and I believe this wholeheartedly, to the point I put this front and center on my firm. I mean, we're a boutique M&A thing, and we go in, we lead with every pitch on the way that we approach it. And I know you the same. You have to be in sync. I am vehement with my clients. We have to be in sync. You cannot do anything without me and your banker being on the same page, because you want to negotiate these things from the same position. Yep. And what's very, very easy to do is everybody with their respective disciplines starts interpreting it different, relaying it different, this, that, and the other. If there's an advantage of the big guys, and there's definitely disadvantages. The big guys, they have the money, they've been through the process, they can, even with all their BS, a lot of times overthinking, not taking any risk. At the end of the day, they can get through a transaction. Where you can, as a business owner, have the advantage is to make sure you're more in sync, because they're going to likely bring that group think dynamic. I'm not saying 100% of the time, but I'm saying in my experience, it's most of the time. So if you are on more of the boutique side and on the seller side, being in sync is critically important, so that it doesn't become my lawyer saying that no client is saying, right? And that's much easier to get a deal done and much more difficult to pin it on the advisors in those cases.
Let me ask you both then. Do you find there is a correlation when the advisor, the attorney, or other aren't aligned to where there's higher cost, right, of doing business?
Yeah, absolutely. And I think one of the things that happens, and not surprisingly, this happens more with guys than with women professionals. There is this, who's the bigger expert thing. And so the argument isn't about, what's really most important in terms of making sure that what the buyer wants to validate and the seller wants to share, get matched up, or what the term that the buyer offered and the way the seller helps to answer the diligence request to validate that. The divergence point is usually who's the bigger expert, right? And what we find is that sometimes when you've got, you got to make sure that you have knowledgeable, experienced M&A attorneys on both sides. It is a huge mistake to use, your real estate attorney to try and do an M&A transaction. And the reason I say that is that if they've never been through disclosure schedules before, if they've never been through the kind of reps and warranties that you go through on selling a company, even if they've done similar stuff on a real estate transaction, it's just different. And they're going to get out lawyered by the other side. And the job of the investment banker, in my view, is to get the right number from the right buyer. And the job of the lawyer is to make sure that my client gets to keep it 100%. And that there's no way for it to get clawed back, taken away, or, kind of technicality away, right? And so the alignment between the advisors on either side of the ball has to be, really, really critical there. And it's important that they have at least similar skill sets and then good division of labor. I don't bring anything to legal diligence. And I hope I'm not the one that needs to do the bulk of the work on disclosure schedule. On the other hand, we have been in situations where clients' choice of lawyer had no M&A experience. And so, we, in that case, actually had to go to our buyer and say, our client's lawyer has never done disclosure schedules before. He committed to this lawyer doing the deal. Would you give us your disclosure schedules? And, in this case, the private equity firm and their lawyer is saying, so you're saying that what you want from us is the document that we're expected to mark up. You want us to pick up the pen on that first?
Yeah, and that just, you lose credibility in a big way. It sounds crazy for everybody listening. This sounds crazy. It's not as crazy as you think. These things come up all the time because, again, remember, most business owners are really good at their business, and they might in fact, all of them underestimate doing a transaction like this. So it's actually seems crazy, but it's very relevant.
Yeah, and it gets, look, if the advisors are willing to bury their own ego or at least set it aside for a minute and actually have that phone call and say, look, we can get additional counsel or new counsel involved, but we're not going to be able to close on time. So it's up to you. I know that we can't get these disclosure schedules, filled in time with current counsel, right? And to be fair, the two clients that I've had that have both, chosen sort of college buddies to be their lawyers in the transactions. I mean, I couldn't fight them on it in the sense that it's a long-term relationship. All I could do is say, this is going to make closing the transaction less certain. And I can guarantee you may not care about this, but I can guarantee you it's going to make my job a lot harder as we get down to the final stretch. And, look, you can't blame people for wanting to have loyal people around, people that are familiar, because you spend 30, 40 years building up a business. You've probably spent a lot of that time as a successful entrepreneur ignoring well-meaning bad advice. Now, you're bet the company. Now you're at like the goal line. You're selling the thing you've built and you have to take advice from a bunch of people that you don't have a long-term relationship with. That's hard to do as an entrepreneur.
It's really hard. And this is a great segue for us to talk about the business development piece, because I know one of the challenges for me is we're not preparing an estate plan for you. We're not filling in documents. It's going to be tough. Tough lawyers think they know everything. Same with their financial people. And you're going to have to trust me really quickly. It's an intense relationship and a lot happens. You have done a marvelous job and I can see why you do it. For the audience, before Brian and I got sick, we had a kind of a meet and greet call with Kirk, and it just really resonated, at least as a transactional person. I believe his personal values and philosophies are similar to mine. And I would like to think I'm a little bit contrarian and what I believe is a positive way, but maybe not everybody does. And you've been able to, do $1 billion worth of deals, which is really, really significant for a middle market or lower middle market, whatever you want to say, banker. You've raised $1 billion in capital. I know how difficult raising capital is. That's a whole nother animal so Kirk, how have you done such a great job of building your pipeline, your revenue? You mentioned you're in a position you get to work with the clients you select. We would all love to emulate that. So take us through it.
I feel like I ought to come up with a technology glitch right now rather than answer the question, how have you done such a great job? At the risk of being, look, thank you, Pat. I appreciate that. Thank you, Brian. I appreciate, we did have a fantastic call. And I would say, it goes in both directions. I mean, we were kindred spirits on that call. It was like, we're vibing because we all hold the same sort of values. We kind of operationalized ours in the way that we started communicating who we were. So my thought was that I'd been a partner in a private equity firm for 7 years. And then I had also been advising sellers as a financial advisor for 5 years. So I had a lot of M&A experience and I had 30 years of finance experience. And so I've been involved in a lot of deals, a lot of direct investments. I've been part of buying 14 companies. I've been part of selling close to 60 companies. So I've been involved in a lot of deals. Now, that includes times where I was like ninth guy on the deal team. I knew nothing. And then other times where I was leading the charge, right? So it's a whole bunch of useful scar tissue. And what my takeaway on most of what financial people or highly technical people, where they lose people, is they don't explain the complicated terms they use. And because they're not quite sure why they're valuable. They're not quite, it's a fundamental insecurity thing. And so I will tell you that 18 years of being sober, lots and lots of therapy, and going to things like the Modern Elder Academy and studying Stoicism and trying to continually work on who I am and how I can be useful, inform the idea that when we launched Candor Advisors, we started posting a video each week on LinkedIn. And it would always be around the idea that the things that don't get explained enough should be explained. in clear term. And, my daughters back then were both in their, mid to late 20s. And one of them was in finance and one of them was involved in digital marketing. And they would both tell me that they understood what I was talking about, that they got it from the video. And then when we started getting a lot of inbound traffic to the website, our website looks, I think, pretty good now. But when I first built it, guys, it was a mess. Right. So I don't know how anybody got to our website and figured out what we did because I designed it. Right. Thank God I found somebody who was actually good at web design, and he built the insights section where we now have like the 170 most useful videos that we've done. And he, and then one of those daughters now works for me, kind of working on this messaging and making sure that we get things across to people. So we did things like when we post our videos, before we put up the intro, we not only run it through AI to ask AI to make it clearer, but then we run it through the Gunning Fog Index to try and make sure that 8th grade and below could understand what we're saying. We're not talking to, I don't care if Frank Quattrone or Ken Mola sees my videos and understand. Those are two famous investment bankers for the listeners who don't know, but I don't care if those guys find my videos embarrassing. I'm trying to talk to the person with a high school education who's effectively a pipe bender who's built a $50 million in sales, 10 million in EBITDA company, and he wants to sell it. I want to connect with that guy. I want that guy to understand what I'm saying. So I want him to understand why Charlie Munger calls EBITDA bullshit earning. That I want my client to understand what a half turn of EBITDA means, or airball and no airball financing means. I want him to understand the difference between, senior debt, mezzanine debt, unitranche. I'm going to break down all those terms. So coming back around to your question, what happened was, we were putting up the video. And then because I'm an introvert who had spent 30 years in an extroverted part of the profession, I was exhausted. I did not want to go to ACG events. I did not want to network anymore. I didn't want to go to coffee with you and talk adjacent to what we wanted to talk about. And so my thought was, well, okay, we're all in the middle of lockdown anyway, so I can communicate like this on Zoom or some platform like this. And so what ended up happening is we got lots and lots of inbound traffic to the website. And then we started, with our digital marketing, reaching out more to a select group of cities to say, kind of send these videos. And we get very few unsubscribes, and we get lots and lots of people. And the most common thing to happen when I get on a Zoom call with a prospective new client is they start with saying, first of all, they're like, oh my God, that's you. Right? Because they've been seeing me in the same background for a long, long time. So they feel like they know me already, right? Sure. It's like we've known each other for a year, 2 years, 3 years, because they've been watching my videos and here I am in the same spot. The next thing that typically happens is they'll say something about having watched my videos for a long period of time and they feel like I'm really authentic. Now, I believe that I am, but how would they know that? They haven't met, right? So there's something coming across there. And I feel like it's incumbent on us then to deliver on that, to say, can we help you or not? Can we be useful or not?
Based on wanting to be of service and wanting to educate, right? That was the initial focus. It wasn't like you were looking at this. And revenue and scaling is my area of expertise. And that's something that I am passionate about. And so what I find is there is a direct correlation to when you're being of service and you're doing the right thing and you're answering the questions that people have that they want answered. Yeah. Then all of a sudden it becomes your brand. And now all of a sudden, again, you're getting this traffic and people are looking at you as the knowledge expert. I've done some work with Pat's firm, and Pat can attest to this years ago, is when I talked to him about the pivot of just don't be a transactional business, be more. You went to become an entrepreneur on your own for a reason, right? Yeah. Explain the reason, explain the why, but really get into the nitty gritty of what you think doesn't get advertised. And I think that's really important. And as a result, you're having a problem that everyone will love to have now. It's the ability to say no to business when everyone's worried about how am I getting business.
I want to give some credit real quick to Brian because he makes a great point. I mean, Brian and I have been great friends and done some business stuff together and all that. But going back like 10 years ago, digital marketing has really, really evolved. It's really, if you think about what LinkedIn was, where it was kind of like, I mean, think about how different it was 10 years ago versus now. Brian was very innovative and gave me some great advice and is why he's great at what he does around what I recognize in what you're doing and what you're saying. And what's interesting is we've done a lot of the same things. I think you've done it better, candidly. I mean, there's some things that you've done that I'm going to try and replicate and am moving in that direction. But Brian is an expert and in terms of kind of, and always has been, in looking at those things and kind of bring them to life. And it's so true with how things have evolved. So good on both of you, because not only do you see it, but he saw it as well.
Well, thanks, Pat. I would tell you that was not intuitive to me. And, most of the things that I can speak about now with some subject matter expertise, I had to either be willing to, like Simon Sinek says, be willing to ask the really dumb question, or to sit there and feel really insecure and deal with a lot of imposter syndrome for long enough to where I was so uncomfortable that I finally just kind of Tourette's out the question, right? And I did it, I spent 6 months when I joined the private equity firm. I was the partner in charge of fundraising and investor relations. And I had been in the finance business for 20 some years at that. And the only person more experienced than me in finance at that table was a guy who was in his 70s. And I was in my late 40s at the time. And all the other people had a lot of M&A experience, but none of them had been in the business longer than me, except that one guy in his 70s. But still, they used words that I was unfamiliar with. They used phrases that I didn't recognize. So I felt like I showed up for choir practice and hadn't had like the materials, and I'm like trying to mouth the words. And finally, I started asking dumb questions. And, I'll tell you, that it continues to this day. The biggest transaction we've worked on so far, $310 million life science transaction. We worked on this with another investment banker. And I was referred in first to then interview that investment banker and decide if they were the right investment banker. So you can imagine how much they loved meeting me for the first time. Their M&A attorney gets the investment banker's engagement letter from, and these are people that are both PhD organic chemists, one of whom postdoced under a Nobel laureate in genomics, right? So these people are smarter by a factor of like 19 over me. I haven't earned the right to be in the same conversation, right? Their M&A attorney has said, this might be the right investment bank and this might be the right kind of deal for you, but you need to talk to Kirk first, right? The first conversation I say to this woman, who is brilliant, who was one of the first 20 employees at one of the biggest genomics companies in the world, and then started her own, built it up to this amazing thing that we had multiple public companies want to buy this company. And the first conversation we had, I said, I've read 2 white papers on the subject of what you do. I've looked at your website. I've looked at a couple of competitor websites. And I have to admit that I don't understand what you're talking. I don't understand. So if that's important for your deal, I'm probably the wrong guy. That was my sales pitch. That was the entirety of my sales pitch. She just started laughing. And she said, I can explain what we do, but Jim says you're a good deal guy and we don't know anything about deals, right? And so I will continue to lead with that strategy. I will freely admit what I don't know, right? Because I know I'm clear on what I do know. I'm clear on where I'm useful. Everybody in every conversation has stuff they're uncomfortable with that they don't know, right? I'm just maybe a little quicker to go ahead and lead with it. Admit it.
So let me ask you this, because I know we're getting up on time here. But what is the one thing, or maybe it's a few things, that you still enjoy? You sound overly passionate about what you're doing. So what is it? What are those things that you still really enjoy about the clients, the deals, all of the above?
So this is going to sound disingenuous, but I love entrepreneurs. I love business founders. I can't tell you how many, whether we end up representing them or we refer them somewhere in the Candor network, or We coach them along to maybe do a deal down the road. Virtually every founder I talk to, I am either completely surprised or blown away by the idea that they looked at a problem that needed to get solved, or they saw something and thought they could do it better, and then built a company, and they have created this wealth out of this idea that, and because of NDAs, I can't go into detail on some of these things, but I will tell you that, these are people that build great lifestyles out of businesses that generate $2 or $3 million a year, that nobody pays any attention to them unless they have like the name of their company on the side of a truck somewhere or something like that. And they've like put kids through school, and they've built this great life, and maybe they have second homes and whatever else. And now they're looking to get to the finish line, and none of their kids want to work in their business, or private equity firm won't pay them enough for their company. And they're trying to get to an out. What I want to do, the only interest I have in scaling Candor Advisors is in trying to serve more of those kinds of businesses, because it's pretty neat to work on a $310 million transaction. The way investment bankers get paid, we're going to do okay on that. We're going to store up some nuts for the winter on those. I tell you, the interesting thing to me about scaling, and it's why we built EBITDA University too, is to try and educate more of those founders who are either too small or too early to go to market on how they can. We can't tell them how to make their business better, but we can help them to understand what might make it more valuable if they're willing to do some of those things. And so that piece, that kind of purpose over profit piece, Brian, that's the thing that's really animating us of late.
That EBITDA University thing is a fascinating thing and a needed thing. Brian and I have had, we've analyzed that business in and out. So good for you. That's not what your everyday investment banker focuses on. They might say they do, but I think if you're honest, the average investment banker doesn't. So that's a really cool thing. Maybe that merits another visit to Biz Mafia. We'd love it. This has been amazing. I think there's so many different directions and finished stuff, but that's what made it great, right? The time just sort of flew by here.
Yeah.
Kirk, so super appreciate what you've done, what you bring to the table. You're a heck of a cool guy, and keep doing what you're doing. I hope we can do a deal together.
Thanks, guys. You guys are awesome. Love this. And let's keep iterating.
Well, thanks, Kirk. We appreciate your time. And like I said, we'll hope to have you back again in the future.
And as our official sign off, as you become a made member of Biz Mafia here today, Kirk, Biz Mafia is what?
Where business gets made.
Yes.
Thank you,
Thank
Kirk.
you, Kirk.